Hello, everyone. So let's first start with introductions. I am a chartered accountant. I did ACCA and then, I did ICAEW, and I've been teaching from past 7, 8 years. So yeah, what else? Okay, I have a dog and I'm a bit of a sneakerhead. So in today's lesson, what we are going to do is we are trying to reverse engineer task 2. So we are going to start with the questions which are frequently asked in task 2, and we try to understand what are the skills. So we are going to analyze the questions. These are the questions that I have compiled. So we are going to talk about these questions, the requirements of the examiner, and then we try to reverse engineer what are the skills required to complete this task. We talk about the skills that we require and we talk about them in detail, and then we do a couple of practice questions as well. So we have the question, identify and explain the cause of the weakness. And we have explained the potential consequences for the business. We have, it means we need to identify the weakness, and then we need to learn how we can find out the consequences for the business. What are going to be the negative financial and non-financial implications to the company? Okay. And then we have the question like identify the appropriate score for each of the risk identified. So, here we are going to learn scoring. I hope most of you already know. Okay. In another type, we have, again, another question, identify 2 circumstances that may allow misappropriation of funds or assets to occur. And then, we have to complete the sentence below to explain the impact. Okay, so we need to learn misappropriation. What is misappropriation, and how can we detect it, and how can we prevent it? All right, so misappropriation is the key word here. And then we have complete the sentences below to explain the impact that this will have on the financial statements. Again, we have the impact, okay? So identify 2 circumstances that may allow misstatement of the financial statement. So we need to learn about what misstatement is, which of the following procedures would have prevented. And then we have prevention of the fraud, which of the following procedures would have detected. Here we have detection of the fraud, and which 2 systematic weaknesses enabled this fraud to occur. Again, we have identification of weakness. Okay, identify the fraud that could occur from the information outlined below, above. So that's one of the questions. And explain why the risk has arisen. Again, that's the identification of the weakness. Make recommendation to minimize each risk, that's prevention. Which of the following is not an example of misappropriation of assets? This means we need to learn misappropriation of assets. Then we have identify whether the following controls would have prevented this fraud, detected his fraud, or have no influence. So, again, we have prevention and detection. All right, cutting the chase, the things are repeating themselves. So I just figured out that the key skills you require to do task 2 is you need to understand what is going to be the impact on the financial statement. Okay, we need to understand if a certain fraud occurs, what's going to be impact on the financial statement. Okay, so this is one skill that we need to work on. Second skill we need to work on is identifying system weaknesses and fraud risks. Okay, we need to learn how can we identify system weakness and how can we identify fraud risks. We can only identify the weakness of the system if we understand the system. If we know the right system, what should be the right internal controls of, for example, sales management, for example, payables, for example, receivables. So whatever system we are talking about, if we understand that what should be the right system for a particular procedure, so then we'll be able to identify that, okay, this is the point where system is weak, right? So we need to learn how to identify system weaknesses, and then we need to learn prevention and detection controls. Then we are going to talk about fraud metrics and misappropriation, okay? And then we are going to talk about risk assessment and scoring, all right? So these, when I was going through the past exam questions, these are the 5 key skills that I think most of the time is required by the examiner, okay? So one by one, we are going to talk about each skill, okay? Any questions so far?
No, I'm all right.
Okay.
I'll go take.
Let me see if we have.
Will you talk about likelihood and impact as well?
Yeah, we will.
Okay.
When we talk about this risk assessment and scoring, we are going to talk about, and in the fraud metrics as well, we are going to talk about that.
Okay.
All right, someone is asking something. Okay. All right. So first thing we are going to talk about is the financial statement impact. So how a certain weakness affect financial statements, right? How many financial statements we have, and what is the purpose of financial statements? Quickly, I'm just going to skim through because I assume that most of you already know about this information. Okay, so the first thing is that why do we need financial statements in first place? So company, has shareholdings, and it means that various individuals own a certain company, which we call shareholders. And directors are running the company. Shareholders are owning the company. Shareholders are the biggest stakeholders of a company, right? So shareholders and other stakeholders like government, like society, like your suppliers, your customers, they are interested in your financial performance and in your financial position, okay? So when we say financial performance, it means that how much money you are making, right? So if a shareholder is planning to keep the money within the business, so they definitely want to know that how the financial performance of the company is going. In the same way, shareholders and other stakeholders would also know about the financial position of the company, how many assets and how many liabilities company have. So we make a set of financial statements for the companies which are registered on the stock exchange. They are regulated, and regulations make it mandatory for them to publish their financial statements. So financial statements include statement of financial performance, which we also call profit and loss account. You have statement of financial position, which is your balance sheet. We have statement of cash flows. Statement of cash flows actually tells that how much cash is coming in and how much cash is going out. Then we have statement of changes in equity. Okay, so this is the set of financial statements that a company is required to make and publish so that shareholders and other stakeholders can have that information, right? So as an accountant, this is the prime responsibility of an accountant, that the statement of financial positions are representing true and fair view. Okay, that's why we have so many standards. We have IFRS, we have IAS, right? So we are trying to follow all of these standards so that financial statements are representing true and fair view. Okay. When we say the financial statements are representing true and fair view, from the perspective of statement of financial performance, your sales should not be overstated. Your sales could never, ever be overstated. So if the sales are overstated, it means the financial statements are not representing true and fair view, right? In the same way, you don't want your sales to be understated either, right? So in the same way, expenses should not be overstated or understated, okay? What fraud does, it actually affects the true and fair view of the financial statements, right? So you have a certain weakness, and that weakness is causing a fraud. Either it is impacting, if we're just talking about the statement of financial performance, so either it is impacting the sales, or it is having an impact on expenses. You don't want either of the cases, all right? So this is one of the biggest problem with the frauds, that they distort the true and fair view of the financial statements, okay? All right, what does statement of financial position represent? Statement of financial position primarily represent assets and liabilities. Asset is something which a company controls. Liability is something which you have to pay to someone. Like your inventory is your asset, your non-current assets like property, plant, and equipment is an asset, your vehicles is an asset, you have any receivables, that's your asset. So any of the assets should not be inaccurately valued, okay? You don't want your assets to be either overstated or understated. Okay, so for example, there is a weakness in your system and a fraud is going on in which there is theft of inventory. So what is happening? Your assets are undervalued, right? Like for example, if you have the assets of 500,000, but 100,000 of the inventory is stolen, so you are writing 400,000 in your financial statements, which means your assets are undervalued, right? You don't want that, okay? So weaknesses affect the financial statements in two ways. One is inaccurate asset valuations, and the other is misstated revenues and expenses, okay? Any questions so far?
Nope. No.
All right. All right, so what are we actually talking about? We are talking about the skills required to tackle task 2. First skill we need is we need to understand the impact of any fraud on the financial statements. Okay, so we are talking about that. Okay. In financial statement impact, we have other consequences as well, like along with the financial implications, we have non-financial implications as well. You know, like for example, if a theft is going on, okay, if there is a company where theft is going on, so the problem is that if someone is stealing the money and making the expenses overstated, it means company is not making the profits which actually it would have been making without that fraud. Okay, that's the financial implication. Okay, in the same way, for example, if you are understating the sales, okay, if you're understating the sales, it means you are again not showing the profits which the company should have been showing, right? So a company might expand too quickly because it thinks that it has more resources. So sometimes, you know, for example, if the inventory is overstated, okay, sometimes businesses would like to overstate their assets, right? So they don't have that inventory, but they still are writing that. So that means they are overstating their inventory. If they are overstating their inventory, so the business is thinking that they have those resources, but in reality, they don't have those resources, right? So it would lead to wrong decision making, okay? So this is financial implication. Non-financial implication is, for example, if a customer learn that a company has been inflating its sales numbers, they might take their business somewhere else, right? So you have the reputational damage, okay? This is your non-financial implication. Okay, so again, let's try to sum it up. So what type of implications you can have your income statement and balance sheet? You can have your overstated sales. You can have your understated sales. You can have your overstated expenses. You can have your understated expenses. And same can be done with assets and liabilities. That would lead, okay, so the financial statements are made and the assets which are written in the financial statement is not actually the asset which company owns, right? So decision maker, I am an investor, right? I'm an investor and I'm looking at the financial statements of the company and I see that they have, all right, so they have like assets of $2 million, but they don't actually have that. Right?
But then, and inside out again.
Okay, so you know, they don't have that assets. Okay, so what I'm doing is I'm actually making the decision on the basis of the information which is wrong. Okay, so this is financial implication. That can be true for the investor, for your supplier, for your customer, for the government, for the tax authorities, right? So anyone which is reading those financial statements, they are gonna make wrong financial decisions. Okay, this is financial implication. Non-financial implication is like if you know that a company is involved in window dressing, we call it window dressing. Let me write it down. This is a good term. You need to know about it. Window dressing is a term in which the accountants tend to show their financial assets more than they actually are. You know, we have a very famous case of Enron in which they were showing that they have operations in South America, and you know they were just issuing new shares, and what they were doing, they were actually, you know, giving more dividends to their existing shareholders to show that they are doing really good, right? So existing shareholders were getting more dividends, so new investors were thinking that the company is going really good, so they were investing more money. And at the end of the day, it was actually a pyramid scheme in which they were raising the money from issuing new shares and giving it back to the shareholders in the form of dividends. They had no operations in South America, right? So the name of the company is Enron. If you want to know more about it, that's a very famous case. Okay, so
What should you do?
if you have wrong financial statement, so you know their auditors, Andersons, they were accomplice in that with them, and
Really?
you know
Right.
we had like Big Five earlier, you know, KPMG, you know, Deloitte and PwC and everyone, right? So we right now we have Big Four, but earlier we used to have Big Five. But Anderson, after that scandal just came onto the surface, they had to close their operations. Okay? So that's a typical example of a fraud happening with collusion. Okay, the word is collusion. Yes. Okay, so, all right. So we are talking about the consequences of misstatements. We talked about the financial implications. Financial implications can be for anyone who is reading the erroneous, misstated financial statements. Okay, like the shareholders, the new shareholders of the Enron, they were reading the financial statements which were completely wrong, so they were making wrong decisions. Okay, non-financial implications. You know, your customer, if you know, like for example, if you are a textile firm and you are a textile manufacturer and you are providing uh, your goods to the retailers like Zara, like H&M, for example. Okay, so they are your customers. When they know that you are misstating your financial statements, they would no longer continue working with you, because the problem is that you have the reputational issues, so they are not going to work with you. All right. Okay, so the first skill we talked about is the financial statement impact. Okay. Yeah. So we talked about this. We talked about financial statement impact. Okay. The second thing we want to talk about, which is most crucial and which is basically tested for majority of the marks in your task 2, is identifying system weaknesses and fraud risks. So we learned while we were going through these questions that examiner is asking about the identification of weakness many of the times. Okay, so what we are going to do is we try to understand the system, and then we try to identify the weaknesses in the system. Okay, so identifying system weaknesses and fraud risks. What are the common weaknesses in systems? We have lack of segregation of duties. Okay, lack of segregation of duties. Like if your business involves cash and there is only one person who is handling that cash, it means that one particular person is solely responsible and accountable for all the cash which is being collected. Okay. Problem is that in this type of system, there is a high risk of fraud because that person don't need to talk to anyone. All he need to do is to just, just take the cash and, just misappropriate it. Okay. So what we do, we try to put segregation of duties as a tool of control system. Okay. We try to put segregation of duties as a tool for controlling our system. Okay. All right. So, like for example, let me just explain you with the help of an example. All right. So there is a person who is responsible for paying the invoices. You are a manufacturing concern, like you are the textile company. Okay, you're getting the supplies and you are making the payments, and there is only one person who is responsible for both approve and pay invoices. So they can easily create fake invoices and pay themselves. Okay, what you need to do is the person who is going to approve the invoices should be a separate person or a department, and the person who is paying the invoices is a different person. Okay, so you have involved a layer, right? And you are trying to prevent the fraud in this case. Then we have inadequate physical controls. Like if your storage room is unlocked, okay, so anyone can just walk into the store and can steal the inventory. Okay, so inadequate physical controls. So while you're doing the questions, while you are attempting the questions, you need to keep this framework in your mind, and wherever you think that these are, one of these things we have in the question, it means that this is a weakness. Okay. The biggest culprit is cash. So whenever you see the word of cash, your alarm bells should be ringing, because the cash is the biggest culprit for fraud. I mean, not the cash, but the person who is misappropriating the cash. Because doing fraud with cash is the easiest thing. There is no trace. There are no documents which needs to be changed. There is no track. Okay, so cash is like, whenever you see the word of cash, your alarm bells should be ringing. Okay, so if you see lack of segregation of duties in any system, in sales system, in procurement system, in payables, in receivables, in inventory system, in non-current assets. So wherever you see lack of segregation of duties, it means this is the weakness of the system. Okay, so you have identified one weakness. Okay? You're going through a scenario and you realize, okay, there is no segregation of duty, so that's the identification of the weakness. Okay, and we can have the inadequate physical controls. Your storage room is not locked. Anyone can walk inside and steal the inventory. Okay, so that's another example of weakness. Then we have poor access control. The computer in which you have the financial accounting system, your software, which is doing all the transactions and everything, that is not password protected. Okay, so if the system is not password protected, anyone can access the system and can make the changes. Okay, or if there is a password and all employees knows the password, okay, so anyone can change the financial records, right, without being detected. You know who's done it. So poor access control is the system is accessible for everyone, either without a password or if everyone knows the password. So that's one example of poor access control. When we are talking about the systems, we have these ERP systems across the organizations, and every individual, like the production manager, has access to the production module only. Okay, your financial manager would only have the access to the financial module. Okay, and even in that module, you would have the tiers. The CFO would have access to a certain tier, right? And then you have the finance manager. He definitely would have a certain level of approvals he can give. Then we have the managers, and then we have the accounting staff, right? So you are, even within the department, you have layers, and that should be a very robust system. And you should be very particular about that, because that's the easiest thing nowadays. That anyone can access the system and can make changes. You can, if you have, okay, let's talk about that. If you have access to the financial system of the company, what can you do? You can initiate a fake transaction. Okay? And then you can make a fake invoice and pay yourself. Okay? You can make you can actually show an expense which is not actually happening, and then you can take that amount to yourself. You can, if one of your customer pays, you can take that money and show that the customer never paid, or you can delete the whole data of the customer from the system. Okay, the system itself has the controls, like whenever someone tries to do that, we call it bugs, right? So the red light would be blinking and showing that this person has made that change. Okay, so you have the alarms, you have the rings, you have the bugs. So what they do is they actually tells the which person has done that. But this is primarily true for the small and medium enterprises where system is not robust. Okay? They are using the financial accounting systems which don't have many controls inbuilt. So yeah, if one of your scenarios say that the financial system is not robust, it means that this is a weakness. Okay. All right, so what we are doing, we studied about the impact on financial statements, and now we are talking about the identification of system weaknesses. Okay, so we have poor access control, and then so we talked about the poor access control. Now we can talk about the lack of authorization procedures. So Authorization is like if amount exceeds a certain level, either in the case of an invoice or in the case of like purchasing, if you are paying to your payable, if amount exceeds a certain level, there should be levels of authorizations, like I said. Like, for example, you can say that any expense below 500 can be made by the junior accountant. But if the expense exceeds that amount, that should be authorized by the manager. And if that exceeds 1,000, so it should be authorized by the financial controller. I mean, it depends on the type of organization you're talking about, and the tiers can differ from company to company. But yes, you need to have an authorization procedure. Okay. All right. Then we have insufficient reconciliation processes. Okay. Insufficient reconciliation process, reconciliation. So like, for example, we have bank reconciliation statements. Bank reconciliation statements are the type of statements like you are making the cash book in your company and bank is maintaining your account as well. At the end of a certain period, your balance should be equal to the balance which is maintained by bank. If there is any changes, you understand that these changes are understandable, okay, that's fine. But after you made adjustments for those changes, if still there is a gap, it means that there is some fraud or error, okay? So what we are trying to do here is we have to have sufficient reconciliation processes. Like your debtors should be, your total number of debtors, the amount of debtors should be reconciled with the information given by the debtors. Okay, same is the case with creditors, which we call payables. Okay, your payable number should be reconciled with the payable number given by your suppliers. Okay, so you need to have sufficient reconciliation processes in place. If you have insufficient reconciliation processes, that's a weakness of the system. And then we have weak IT control. I think we talked about that. If your IT is not robust, so that's another weakness of the system. Okay. Now we are going to talk about weaknesses in each system. Like we're going to talk about payroll system, inventory system, receivables, and so on. Okay, so let's take like a 2-3 minutes break, 5 minutes break, and then we'll resume. Okay, we'll keep the meeting going, and then we come back in 5 minutes. All right.
And may I ask you one question? Hello?
Hello, yeah, can you hear me?
Yeah, and may I just ask one question?
Yeah, if it's quick, yes.
Oh, yeah. It's like you say like the command weakness in the system. Can I just literally in the exam, can I just write like poor access control instead of no password protected?
Yeah, you can write that. I mean, that is a weakness. I mean, we are definitely going to talk about, I mean, once we are done with the concepts, we are going to talk about the scenarios as well. And then, we'll discuss all of these things, that how we are actually going to identify it in a particular scenario. It depends on what type of scenario it is. All right. So yeah, we will talk about it. So in an ideal situation, yes, you can write that the computer is not password protected.
Okay, yeah, so I can just like write down a weakness is IT control, and I don't need to write down like no password protected.
No, you cannot do that. You have to be very particular. I mean, you have to give them the specific detail that why do you think the system is weak.
Oh, okay, yeah.
You cannot give them a generic answer.
Okay, thank you.
Okay, so we are done with the implications on the financial statement. Like if you have a weakness, and because of that weakness, there is a fraud going on. So what's going to be the implications on financial statements, right? Then we talked about the identification of the weaknesses, so in which we talked about the lack of segregation of duties. We talked about inadequate physical controls. We talked about poor access control, lack of authorization procedure, insufficient reconciliation processes, and weak IT control systems. So whenever you see anything related to these things, it means you have identified a weakness, okay, in any of the system. It can be true for sales, it can be true for purchases, for payables, for receivables, for inventory, right? Okay. Now we are going to talk about identifying system weaknesses in specific systems. Like if we talk about payroll systems. So in payroll system, there is a risk of having ghost employees. So for example, an HR person might add a fake employee and collect their paychecks. Okay. And that has actually happened with the companies. So when the systems were not so robust, so you could easily just add a fake employee, and every month, that person is getting an extra salary, imagine, or probably more than one salaries, okay? So that's ghost employees. Then we have unauthorized payroll adjustments. Unauthorized payroll adjustments is, you can make the changes in payrolls of your employees without authorization. So an employee might increase their own overtime hours without permission, okay? So that's unauthorized payroll adjustment. And then we have timesheet fraud. So timesheet fraud is a worker might clock in for extra hours they didn't actually work. So what they can do is they can actually play with the timesheet. Okay. In the previous case, when we were talking about the unauthorized payroll adjustments, so that guy was making the adjustments at the end of the payroll system, when the payroll system was just about to make payments for paychecks for everyone. So that person rigged the system and added a couple of extra hours for himself. But in this case, the timesheet fraud, that's another type of fraud in which the person is rigging with the timesheet. If the system is not robust, like in many of the offices, you must have observed that we have this finger detection system. So whenever you go to the office, you have to, do this thumb impression. It means that you are in, and when you do, even, employees can rig that system as well. Okay, so these are the type of frauds that can happen with payroll. So sometimes we have seen the questions in which a payroll system is given, and your task is to identify the problems with the payroll system. So these are the type of frauds which you can keep in your mind when you are doing the payroll detection, fraud detection. Okay. Then we have the inventory system. So the problem which you can have with inventory is theft or misappropriation. Okay. So theft is like very easy. It means that an employee, a warehouse worker, is stealing items from the inventory and is selling them. Okay, so that's the type of fraud you could see in your inventory system. Then we have overstatement of inventory. And this is like a very common problem. And many companies which are going through financial problems, the first thing they're going to do is they are going to rig their inventory valuation. And when I was working as a financial analyst with a rating agency, so the first thing, whenever I have a new client, the first thing I want to check is that how's their current ratios and quick ratio is behaving. What's their inventory turnover? And is there any fake inventory, right? So, one of the reasons that businesses does that is they have slow moving inventory. Okay, when they have slow moving inventory, it means they, let's say you bought the inventory, but now you are finding it difficult to sell it in the market. So it means we don't want to go into the detail of the standard, but IAS 2 says that you cannot keep your inventory on your cost, right? You always have to keep it on your fair value, right? So the fair value of the slow moving inventory has decreased because nobody is willing to buy that inventory at the price you bought it for, okay? And if you are keeping that inventory at the same cost, it means you are overvaluing, overstating your inventory, okay? Overstating an asset is like the biggest crime in the world of accountants. When you're making the financial statement, you can never, ever overstate your assets, right? Okay, so another case in which a company might be overstating their inventory is that, for example, if they are having liquidity problems and they need quick cash from bank, let's say. So the bank would be willing to give them cash against their inventory, against their stock. So they have stock of like 100,000, but they need a loan of 300,000. So what they do is they say that, we have stock of 400,000, right? 300,000, 400,000, so that the bank can pledge the inventory against the loan and give them the credit, okay? So these are the type of examples in which a company might be overstating the inventory. So you see that this is happening at company level. The company or the directors of the company, the accountants of the company are defrauding the users of the financial statements, like the Enron was doing with their users of the financial statements. Okay, so this is the case in which a company is showing inflated inventory numbers to secure a loan. Okay, all right. And then, obsolescence, like I said already, if there is, let's say, if there is a tech company and they have computers from previous models which are obsolete now, and they know that nobody would be buying those computers at that price, but they would still keep keep the computers in the inventory at their previous numbers, right? So in this case, standard clearly says that you have to run the impairment test. You have to see that whether there is an impairment in your inventory. If the impairment has happened, so you have to undervalue you have to reduce the value of your inventory, and you have to put your inventory on the new value. Okay, so yeah, if inventory is obsolete, so that can be another case. So these are the things you could see in case of inventory systems, theft or misappropriation, overstatement of inventory, and obsolete inventory kept at the previous cost. We have receivable system. Who is receivable? The person you have to receive amount from, and that's definitely your customer. Okay, so you made a sale to an individual, and they said, okay, you know, we're going to pay you back after 45 days. Okay, so you say, okay, all right, take the credit, and you give them the credit for 45 days. So these are your receivables. Okay, so what can go wrong with receivable system? You can have fake sales, or you can have overstated receivables. All right, why company would be interested in doing that? Why would you try to overstate your receivables? Okay, so there is a manager, and the manager is given a certain target, and year end is, this month is year end, and if he hits the target, he gets a bonus. Otherwise, he won't be getting the bonus, right? So what he would do, he would place some fake sales, okay, to hit the target, right? And you are not going to receive the cash right now anyway, so because you're already providing the credit to your customers, right? So manager would be faking some sales in the last month, so that he can hit the target. Okay, that's how your sales can be overstated. Okay, like we talked about it in previously as well. Overstating sales is one of the biggest crime in the game of accountants. Okay, you cannot overstate your sales, and this is something which happens most frequently, faking the sales, to meet the targets. Okay, so this is the type of problem you can see in the receivable system. Okay, and then we have delays in receivable collection. Okay, so for example, a company might wait too long to chase overdue payments, and that would lead to bad debts. Okay, bad debt is when your receivable is not paying you amount anymore. Okay, that's a bad debt, and that's an expense. So if you're showing certain receivables in your balance sheet, like if there is a person who has not paid from previous 120 days, so there is a possibility that they might not be paying you, ever. Okay, so and if you're still showing it in the financial statement, you are overstating your assets, and you cannot do that. Okay. Okay. All right. And then we have lapping schemes. Lapping schemes is when a clerk might steal a payment, then cover it up by another payment meant for a different customer. Okay, so you have to pay a payment to A, and instead of paying A, that individual take that payment from your staff. He takes that payment instead of paying person A. And then when the payment for person B comes, so instead of paying it to person B, he would pay it to person A. This is called lapping schemes. Okay. So yeah, so these are the type of problems you could see with your receivable system. Let me just quickly give you what we talked about so far. So we are identifying weaknesses in certain systems. In payroll, you can have ghost employees, you can have unauthorized payroll adjustments, and you have timesheet frauds. In inventory system, you have theft or misappropriation, you have overstatement of inventory, and you have obsolete inventory, which you are still which you're valuing wrong. And then you have receivable system. In receivable system, you have fake sales or overstated receivables. You have delays in receivable collection, and you have lapping schemes. So when if any of these things you see in your scenario, it means you have identified a weakness. Okay. In payable system, if there is unauthorized payments. Okay, so an employee could create a fake supplier and approve payments to it. Okay, so if there is no authorization of payments, if there is one person responsible for receiving invoices and making payments, so what he could do is he could just make a fake supplier and he would continue to pay that supplier. And he's not actually paying him, he's actually, you know, misappropriating those funds. Duplicate payments, okay? So an invoice is paid twice if records are not carefully checked, okay? Duplicate payments can be a problem. Then we have misclassification of expenses. Misclassification of expenses is personal expenses of the employees and personal expenses of the owners might be recorded as business expenses, okay? So that can be a problem with your payable system. We have non-current asset system. So there is a possibility of misappropriation of assets. Like, for example, an employee might use a company vehicle for personal trips. Then we have incorrect depreciation. So you are using the wrong depreciation rate and you're overstating the profits, okay? And then we have failure to record disposals, which means a sold machine is still listed as an asset. So you have a machinery, you sold it, but you're still keeping it in your financial statements, in your non-current assets, right? So essentially what you're doing is you are overstating your assets, which you cannot do, like, you know, which is like a very big crime in accountants world. So you cannot overstate your assets, okay? So you dispose of an asset, but you're still keeping in your books so that your books look good. So that's another type of fraud which accountants can commit. Okay. Okay, now we are going to talk about prevention and detection controls. Do you guys have any question from the previous section?
No.
Okay. Okay, let's get back to the skills that we require. So we talked about, the first thing we talked about was financial statement impact, okay? And then we talked about identifying system weaknesses and fraud risks, okay? So in financial statement impact, we talked about how can fraud impact the financial statements. Primarily, it can impact by overstating the sales, understating the expenses, or overstating the expenses, or it can misrepresent the assets or liabilities of the company, okay? We saw that in identifying system weaknesses and fraud risk, that these are some of the examples that you can see in any system. And whenever you see these problems, you say that, okay, we have identified a weakness. All right. Then we talked about the weaknesses in particular systems, all right? Payroll, payables, receivables, non-current asset, inventory, right? Now, we are another skill that we require for answering our task 2 is prevention and detection controls. Prevention and detection controls. So let's see how many times this is questioned in the exams. So consequences for the business. All right. Okay. Which of the following procedures would have prevented this fraud from occurring? Which of the following procedure would have detected the fraud? Okay. Again, systematic weaknesses enabled this fraud to occur. and then identify the fraud that could occur. All right. So this is how this question would be asked in the scenario. So we are going to talk about prevention and detection controls. Okay. So the type of controls which can prevent the fraud. This is the type of control which it is designed to stop errors or fraud from happening. So in prevention controls, you don't want errors or fraud to happen in first place. Okay, like for example, let's talk about a couple of examples. Like we have authorization requirements. So in authorization requirements, for example, a manager must approve all expenses above $500. Okay, so you have given them an authorization limit. So the manager must approve all expenses above $500. Okay. Another example can be excess controls. So, for example, only the finance team can access the accounting software. So you have an access control. Not everyone can access the accounting software. Only the finance team can access it. And like I talked about, you can have different tiers even in that, even within the finance team, like the CFO would have the highest authority, the finance manager, the junior manager. So you can have the levels where you can divide different authorities. Okay. All right. So what else can prevent a fraud? We talked about authorization requirements. We talked about access controls. And then we have employee training. Okay, all right. So you are given a scenario in which you have to identify whether this control is preventive or whether it is it's a detection tool. Okay, so you have to think if the tool is stopping the fraud from happening in first place, it's a preventive tool. Okay, it's a prevention control. Okay, so examples are authorization requirements, access controls, employee trainings. So you are providing your employees with education on how to recognize, for example, how to recognize phishing emails. Okay, so you, if employee recognize a phishing email, so they can obviously, they're not going to click that link, and the company is not going to lose its access. So you are trying to prevent the fraud happening to the company by training your employees. Okay, if this type of email you get where you have won a lottery of $5 million, so that's a phishing email. So you don't need to click that link. Okay. All right, so these are all prevention controls. Then we have detection controls. Detection is like when a fraud or error has happened. Okay, something has already happened. So the problem is that you have to detect it, right? So how can you detect it? There are a couple of tools which you can use. Like reconciliation statements we talked about. So you're making bank reconciliation statement to make your balance 0 with the bank. You're making the cash book at home, and bank is maintaining your account. And at the end of the day, you want the balance of bank equals to your bank, to your balance. Okay. So if that is happening, it means if that is not happening, I mean, if the balance is not equal, so you can say that something wrong has happened. So that's a detection control. Bank reconciliation statement is one of the detection control. Okay, so how would you identify a prevention control and detection control? So the control which is stopping the fraud happening in first place is a prevention control, and the control which is detecting it after it has happened, so it's a prevention, it's a detection control. Like for example, going out in cold, you say that, you know, if I'm going out in cold, I'm going to wear my jacket. So that's prevention control. But once you have fever and you're using the thermometer, that's a detection control. Okay. All right. So reconciliation is one of the examples. Then we have audits. We have internal audits, we have external audits. So internal audit is responsible for doing the audit, which is used internally by the company. And that's part of your internal control system. So at every step, the internal audit is doing the audit of the system and trying to figure out if there is any fraud or error. Okay. External auditor is representative of the stakeholders. External auditor is a representative of shareholders, of the government, of suppliers, of the customer. So he is accountable for external stakeholders. So they would only be telling if there is any misstatement in the financial statements after it has done. So that's why it's a detection tool. Okay. Then we have exception reporting. Exception reporting is a system in which an alert is triggered if a payment is made outside of a regular business hours. Okay, for example, if a payment is made at 2 a.m. from company's bank account, so you could see that, okay, you know, there is a problem with that. You know, company is not going to pay 2 a.m. in the morning, so there is something fishy about it. Okay, so the alarm would go and it would be letting the authorities within the company know that this is happening. Okay, that's again an example of detection control. Okay, all right. So what we talked about here, we talked about that in prevention and detection, sometimes we have prevention controls, sometimes we have detection controls. So that's another skill that you need to require sometimes, because the question asks you to differentiate between prevention and detection control. You need to know that what is the difference. Okay. All right. Now we are going to talk about fraud matrix and misappropriation. So fraud matrix and misappropriation. So the first thing is we need to understand that what is a fraud matrix. So this is a tool which we use to assess the risk of the fraud in different systems. And what we do is we try to identify potential frauds. And we do that by assessing the likelihood and impact. Okay. And we then, we implement the controls to prevent it. All right, okay. So what we can do is, okay, let me just talk about a couple of examples, and then we'll have a look at a fraud matrix. All right, so how can we identify professional frauds? So the first thing we're going to do is we are going to list down all possible fraud scenarios. Okay. For example, in sales system, a potential fraud could be issuing an unauthorized discount. So that's a potential fraud. Okay. Making a fake sale is a potential fraud. Right. So providing an extended credit term can be a fraud, right? So, like for example, we have identified that a potential fraud discount, that issuing unauthorized discount is a potential fraud. Now, then we are going to do is we will assess the risk. Let me write down the procedure. Identify the fraud. Then we are going to assess risk. And once we have assessed risk, we can suggest controls. For example, let's take the example of unauthorized discounts. So we have identified a potential risk in our sales system. We realize that there are a couple of employees responsible for sales, and there is a risk that they would be allowing some unauthorized discounts to some of the customers. Okay, so that's the risk we have identified. Now we are going to assess the risk. Okay, in assessing the risk, we are trying to figure out that what is the likelihood of that risk and what's the impact of that risk. Okay. And by talking about, when we talk about the likelihood of risk and impact, if we realize that this is a high risk thing. Okay, so we assess the risk and we think that, okay, this is high risk. So what we are going to do is we are going to place a control in place to prevent it. How can we do it? Like, for example, I say that I require manager approval for discounts above 5%. Okay, so we identified a risk, a potential risk, we assessed it, and we realized, okay, you know, this is something notable. We cannot ignore it. We have to put a control in place. So we place a control, and when we require manager approval for the discount over 5%. Let me see if I can find a scenario and we can discuss that. Okay, let's make a matrix of different risks. So on one side, we are going to take likelihood. Likelihood, or we can say probability. And on other side, we are going to take impact. So your likelihood can be high, medium, or low. Let's say, you know, high likelihood mean 3 score. Medium likelihood 2, and low likelihood score of 1. I'm not happy with my drawing. Let me make a clear picture. So taking likelihood and probability over here, and we are taking our impact here. The likelihood can be high, medium, low. Or let's make it the other way around, look better. Low, medium, and high. Then we're going to score it 1, 2, and 3. Okay, all right. So if there is a risk of theft, okay, in your in your inventory, and if that theft is happening, it means the company is losing $50 every month. You're pretty sure that this is happening, okay? You're pretty sure that, you know, an employee is misappropriating inventory of $50 each month. The likelihood is high, but what's the impact? Impact is very low. I mean, from $50, it has no financial implications. There is no misrepresentation of financial statements. So impact is very low, all right? It means we are landing in this box. So we multiply 3 with 1, so we have a score of 3, okay? We have a score of 3, okay? Then we have, let's say, you know, we are just sticking with the inventory. So there is another employee who is, there is a likelihood that he is misappropriating some of the inventory as well. And the company is having a loss of approximately 1,000 each month. It's a small company, 1,000 matters. So, but the likelihood is low, all right? Likelihood is low. So, all right, so we are in this area in terms of likelihood, and the impact is medium as well, okay? So, which means we are in this box. 2 times 2 is 4. So this risk is, has a score of 6, okay? All right. Now, there is a risk where the senior accountant is making some fake sales each month, and that is approximately 5,000 every month. The likelihood is very low, right? Because you just have doubt, there is no evidence, no one tells you. So the likelihood is very low, but the impact is high from your perspective. Your company has, let's say, the revenue of 50,000. So 5,000 matters, that's 10% of your revenue, which is significant, right? So the likelihood is low, but the impact is high. So you're landing in this box. Likelihood, impact. So what's the score? The score is still 3, okay? Let's say, you know, okay, so let's try to figure out the scores of each box. Here, you know, in this box, we're gonna have a score of 3 times 2, 6. In this box, we have a score of 9. In this box, we have 2. In this box, we have 6. In this box, we have score of 1, okay? And in this box, we have 2, right? So, you know, okay, what is happening? You know, why do we need to learn this matrix, this fraud matrix? So you have the potential frauds in front of you, all right? And you ask your accountant to make an Excel sheet on the basis of likelihood and impact, okay? So he jot down, let's say, 10 different frauds or 9 different frauds, okay? And you got all of these frauds in front of you, you have the likelihood and you have the impact of those frauds as well. You plug in all of these frauds in this matrix, and now you can set your priority, okay? So I mean, if this is how your matrix is looking like, this fraud is your highest priority because the likelihood is high and the impact is high as well. So this might damage your company significantly. So this is something you need to do as your first priority. So that's your first priority. Okay, let me change a cute color. Okay, purple. So that's your first priority. This is your second priority. Any fraud, with a score of 6 is your second priority. This is your third priority. That's your fourth priority. This is fifth priority, and that's your sixth priority. Okay, so that's how, this is what your fraud matrix is. All right. Okay. Any confusion?
Can I please ask how you were able to categorize the part where we talked about issuing unauthorized discounts?
Sorry, can you please repeat your question?
May I please ask how you were, how you were able to categorize this issuing of unauthorized, the risk of unauthorized discounts?
Okay, so you're asking, okay, you're asking that how we are going to categorize whether the risk is has high impact or low impact. Yeah.
Yes, please. Yes.
Okay. Okay. So it's like, you know, we have a concept of materiality, right? So anything like, for example, if you're talking about the revenue, so anything which is about 1% to 5%, so that can be material. That is more specific. Okay, let me give you this framework. Just give me a second. Let me pull it out. I don't. Anything which is between 0.4% to 2%. It will be material. Okay, like for example, if for $1 billion company, 10,000 might not be material, but for a company which is just making a turnover of 50,000, 10,000 is going to be very material, right? So anything which is like in between 0.4% to 2% of the turnover, that would be material for the company. Okay, like for net profits, which we call profit before interest and tax, anything which is 3.3% to 5%, that would be material. And for assets, anything between 0.1% to 4.8%, that would be material. Okay. But the point here is that this is just the financial implication. There is a possibility that there is a fraud which is financially is not significant, but it has non-financial implications, right? Like it is causing you reputational damage, for example. If that is happening, so at the end of the day, this is just a framework, just a starting point. At the end of the day, you would have to make a judgment whether the fraud is significant or not. And to be honest, it's going to be different for each individual. Probably you might be thinking that the impact of this fraud is going to be medium, but in reality that is high. The other person is saying that this is high. But if you are, from the exam perspective, if you are judging the likelihood of the fraud wrong, and if you are judging the impact of fraud wrongly, for both of them, if you're doing both of these things incorrectly, you would be losing your marks. And most of the scenarios, they make it quite visible for the students to assess whether this is a high impact fraud risk or a low impact fraud risk. Okay, so it's just like you need to just have that framework in your mind, and once you have that, I mean, it's just a little more practice, and you'll get to know that what type of fraud is like has more impact for the business. Okay, all right. So I think we Okay, so we talked about the fraud matrix. Now we have to talk about the misappropriation of assets. So misappropriation of assets is if someone is misappropriating the assets which are owned by the company, right? So, for example, an unsupervised employee might take office supplies for personal use. So that's an example of misappropriation of assets. So it can be due to lack of supervision. Another example can be if inventory is not regularly checked. So items might start going missing. So that can be due to inadequate inventory controls. Okay, how can we prevent misappropriation of our Can you guys see what I'm writing on screen? Or is it like messed up?
It's all messed up.
Okay. So misappropriation of assets, it can be due to lack of supervision, or it can be due to lack of adequate inventory control. So these are two examples. Misappropriation of assets is when employees are using the assets for their personal use, the assets which are owned by the company. Okay. How can we prevent misappropriation? We can prevent misappropriation by, again, having right controls in place. Okay, so remember we are talking about preventing these type of frauds. So we can have regular, like, I'm just giving you some examples. Like you can have regular inventory audits, right? You have monthly count, okay, stock, or you can have segregation of duties, like one person orders inventory, other receive it, and a third person records it. Okay? You have segregation of duties. Person A orders, person B receives, and person C records. So in the whole system, you have essentially included 3 individuals, and you have got the segregation of duties in place. All right. And you can also have the physical security, like installing security cameras in storage areas to deal with theft and misappropriation. So that can be helpful as well. Okay, so these are the type of preventing measures a company can take to prevent misappropriation of assets. Okay, then we have risk assessment and scoring. Okay, so scoring we already talked about. How can we score a certain risk? How can we assess the risk on the basis of likelihood and impact? Okay, now let's talk about the TARA framework as well. TARA framework, that's basically generic framework. Hey guys, just give me a second. I don't know. There is some issue. So in TARA framework, we assess risk again on the basis of likelihood and impact. This is basically a generic risk management framework, which is not only used for fraud, it is also used for many other systems as well. So let's talk about TARA framework as well. So we have the impact, and we have likelihood and probability. So your likelihood or probability can be high or low, and your impact can be high or low. All right, so for example, if you are in this box, the likelihood is high, the impact is high as well. Okay, so what can we do for this type of risk? We avoid it. Okay, we avoid this risk. Because as a company, you don't want to get yourself into a risk which has high likelihood and have high impact as well. So that could threaten the very existence of the company, and that could have a big reputational damage to the company or financial implication. So you would avoid this risk. Okay, we have, if we are in this box where likelihood is high, but impact is low, so you reduce it. You try to reduce this, this risk as much as possible. Like for example, if an organization is having problem with the theft of inventory, the likelihood is high and the impact is low. So what you can do is you can just reduce the risk by, let's say, installing CCTV cameras or or increasing some authorization. So, you would just try to reduce it. Okay. If there is a risk which has low likelihood and low impact, that's the type of risk that you accept. You said, okay, all right, a certain level of risk is associated all the time with the business, so we just accept it. There is no problem with that. And then we have, if you are in this box where impact is high, the likelihood is low, so you transfer this type of risk. For example, car accident. So impact is very high, but the likelihood is very low. So you would try to transfer this risk to someone else. So you would just go for the insurance of the car. Okay. So This is TAR framework. I hope that makes sense to you guys. Okay, now how can we respond to the risk after scoring risk? You know, we scored the risk previously, and now how we are going to score respond to those risks? Strengthening controls. Okay, either we can strengthen our controls, or okay, or we can increasing our oversight. Like you would increase the supervision, you would increase the authorization, you would do that type of stuff. And then you can do your risk assessments regularly. Okay, you do your risk assessments regularly, right? Okay, so do you guys want to talk about risk assessment as well? Let me just quickly give you an overview of that as well. Okay, risk assessment. So risk assessment starts with identification of risk. You identify the potential risks, and you do risk analysis. Risk analysis is when you are assigning likelihood and probability to the risks. Okay, so you're doing the risk analysis. Then you do risk prioritization. In risk prioritization, you assign priorities on the basis of the scores, like we did. Okay, then we have risk management planning. After that, you do risk management planning. Then how can you manage those risks? Okay, you can use TAR framework for that. Okay, then you do risk resolution. Like you are resolving those risks. Okay, and then you place a system for risk monitoring. This is your risk assessment system. Okay. All right, I think we have talked about pretty much all the skills that we require. Okay, so we identified, when we have a look at the past exam practice, we identified that these are the key skills required: financial statement impact, identifying system weaknesses and fraud risk. Then we talked about prevention and detection controls. Then we talked about fraud matrix and misappropriation. And at the end, we talked about risk assessment and scoring. Okay, now let's have a look at some practice question. I made the practice questions for each system, for inventory, for payables, for receivables. I'll send it to you guys on on the group. Payables, for receivables, for inventory, for sales, for non-current assets, for payroll as well. Okay, let's do the one with inventory management. The rest of the question, I'll send it to you guys. Okay, can you guys just read the scenario quickly and let me know when you're done so that we can go to the question. You can message me in chat once you're done reading the scenario.
Okay, we will.
Recorded by the warehouse. Hours. Subprinted. Is subject regulated by statistical controls. Language is and without paper. Content control, that's not secretly. There's no schedule these size control. Troops. Group.
All right, shall we start it? Okay. So our first question is, for each of the 4 weaknesses identified, identify and explain the cause of the weakness. So the first thing we are going to do is we are going to talk about the cause of the weakness. The second part is explain the potential consequence for the business. Okay, so again, you are identifying the weakness, and then you are going to talk about the impact on the financial statements of the business. Okay. All right. So for each of them separately, the first one is okay. Inventory adjustments are made without proper documentations or approval. Okay. So they are adjusting the inventory values without proper documentation or without approval. Okay, so the reason is, we don't have proper controls and oversight, and adjustments are made without any documentation or approval, right? So we need to have a proper internal control system in place to tackle it. Okay, the consequence of that is going to be increased risk of fraudulent activities. So, like for example, you're going to have unauthorized write-offs. Write-off is the term which is used when inventory is impaired, and you say that this inventory is of not the right value, which is written in the financial statement. So you write off the inventory. So what can happen is, because we don't have a proper system in place, we don't have any approvals or oversight. So an employee can misappropriate some inventory, and they can write off that inventory. Okay, so that's the. So what would happen with the financial statements? So if the inventory is written off, which is not actually the case, so you are understating the assets in your current assets, your balance sheet. And you are also increasing the expense by decreasing the closing stock in income statement. Okay, that makes sense? All right. The second problem we have is we have irregular physical counts. Physical counts are not conducted regularly, which is leading to discrepancies between the recorded and the actual inventory levels. So if you are not conducting your physical counts regularly, so the problem is definitely going to be the difference between the recorded inventory and the actual stock, and it's going to make it's going to have a big impact on the financial statement, because the value of inventory you are writing in your financial statements, that is not representing true and fair view. Okay, and if that is not representing true and fair view, the reader of the financial statement is misguided. Okay, so this is leading to inaccurate financial reporting and potential stock shortages. So you are having problem in two ways. One is your financial statement is not correctly made. The other one is even your internal decision making is not correctly done, because you don't know when you would be going out of stock and when you're going to have the stock shortages. Okay, so what you are going to write, you're going to say that these discrepancies between recorded and the actual stock would lead to inaccurate financial reporting, where we would be misstating the assets, the inventory assets in our financial statements, particularly the statement of financial position. And it would also lead it will also have financial implications for the business, because it would be leading to erroneous decision making internally. Okay, these are going to be the consequences of that. Then we have the third thing, which is high value items are not stored securely, making them susceptible to theft. Okay. So if this is happening, the cause is definitely we have inadequate security measures. High value items are not stored securely. Okay, so that's the cause. The consequence is you would have increased risk of theft or loss of valuable inventory. That would lead to the financial statement, financial losses, and potential operational disruptions. So a valuable item is stolen, and it means that financial statements are not representing true and fair view. So you're damaging the financial statement and you're damaging the decision making as well. Okay, the fourth one, do you guys want to try it? You can send your answers in the chat. Fourth one is there is no segregation of duties, as Lisa has control over both inventory adjustments and approval process. Cool, I'm getting the answers. Yeah. Okay, so we say that there is lack of segregation of duties. Let me write it down as well for you guys. Need a little blank space. Okay. I hope you can read my handwriting. I had really small white space where I could write. Very good. I got most of the answers I got are correct. Very good. Okay. Now let's go to part B. The company had discovered that several high-value items have gone missing from the warehouse. Explain how this situation could impact company's financial statements and suggest a corrective action. Okay, so the missing high-value items could lead to understatement of assets, right? Because if the items are missing, it means you are not writing them in the financial statement. So you are understating the financial statement. So if they are not properly accounted for, there would be misstatement in the financial statements. This could also impact the company's profitability due to the loss of valuable inventory, right? Because if something like this happens, you have to expense it, right? And when you expense it, it's definitely going to increase your expenses and decrease your bottom line, your profit, net profit. So that's going to have impact on your income statement as well. So now the second part is what company should be doing to counter that. So the company should implement security measures and conduct regular audits to prevent such occurrence in the future. Like for example, company can increase like all the measures we talked about in a lesson. They can increase the authorization, they can install the security cameras, they can deny the excess, control the excess, and they can conduct regular stock counts and regular stock audits to prevent such situations. Okay. Let me write down this answer as well. Okay. All right. All right. So, I will post some of the practice questions on the in the group, because right now we are running out of time. So I'll post the practice questions. I actually made the questions for everything like receivables, payables, inventory, sales, etc. So I'm going to give you all of them, and then I'm going to upload this this presentation as well. And I hope you guys like it. Do send me a review in my inbox if you like the session. And if you guys think that we need to have a crash course for like 1 week or 2 weeks, so you can also let me know that. I'm thinking about having a crash course with a very nominal rates, because I already know that students have already paid a lot of amounts. So if you guys think that, you can actually text me that as well. Okay. Thank you very much. Bye bye. You can connect me through that page.
Thanks a lot for your time today.
Thank you very much.